Hello, Sylvia. Let us talk about the residential market today. To understand the current situation and today an outlook, it's always informative to see what has happened so far. Last year, residential real estate has been surprisingly resilient despite a big contraction in economic activity.
Indeed, housing markets remained resilient in 2020 despite a sanitary and economic crisis. There has been a halt in activity during the first lockdown, which led to a big drops in lending and dwelling investment in the second quarter of 2020. Nevertheless, lending and investment strongly rebounded in the third quarter once countries gradually reopened their economies. A pause in housing sales during the first lockdown was followed by a strong pent-up demand.
Yes, I remember. In April last year, everybody was trying to figure out what was happening. The CEO of a big housing company told me they stopped their purchase program because they expected lower pricing due to the tight liquidity situation. After months, they approached their counterparties again, but nobody was willing to reduce prices.
Indeed, Dirk, house prices continue to increase in most European countries, with the exception of some tourism-exposed countries like Spain. Residential real estate benefited from flight to core investment amid economic turmoil. Also, there has been a change in household preferences following lockdown experience and increased home office. In addition, lending conditions remained favorable owing to monetary policy easing and relaxation of macroprudential measures, while the adverse impact on the labor market has been cushioned by the introduction of short-time work schemes in most European countries.
You're right. Residential is really the winner of the crisis. There were no constraints on financing residential investments. Margins stayed low, and even the financing of large portfolios were not a problem. You mentioned a change in household preferences. How did they change?
Since the outbreak of the coronavirus, residential prices in the cities have been rising at a more moderate rate, while less crowded areas located farther away from big cities have seen stronger price increases. Households increasingly preferred more affordable, larger properties with outdoor space in less demanded but still well-located areas.
So to summarize 2020, first important point is that prices remained resilient despite economic turmoil. Second, residential market benefited from the flight to core investment. And the third observation is that there has been a change in household preferences and needs, which has been reflected by weakening demand in core cities and rising demand in less crowded areas. Sylvia, will this new trend continue in 2021?
Yes, the new trend will continue. Favorable lending conditions and government support measures will stay in place through 2021 and thus point to a positive outlook for the residential sector this year. Yet, we believe that areas with greater imbalances will see lower demand and possible price declines as households will continue to favor more affordable, less crowded areas.
Do you see any downside risk on this outlook?
Yes, the labor market has become less buoyant, and we expect that the unemployment rates will still increase in the first half of 2021. This will control housing demand. Also, wages will stay subdued this year, which will further weaken affordability. Overall, we expect that weaker wage prospects, along with increased home office and new preferences towards larger properties with outdoor space, will benefit suburban areas and well-connected smaller cities with cheaper housing.
Do you really think we will see deurbanization and exodus from big cities?
No, a vast exodus is unlikely. We still expect cities and city suburbs to attract people, yet demand for small apartments may be weaker and people will look for alternative, inexpensive living options in big cities. We believe that co-living or co-housing residential concepts in cities will have a big potential, as they offer more affordable living possibilities owing to shared facilities, garden, parking.
So to summarize, in 2021, we need to monitor the labor market developments, specifically the unemployment rate and wage growth, as well as the new household preferences and needs.
Indeed, our main calls are that unemployment rates will peak in the first half of 2021 And rebalancing the housing markets will continue, thanks to more space and less expensive housing in the location farther away from the big cities.
What are the regional differences? Which regions will benefit and which will be negatively affected?
In France, houses in Brittany, Normandy, and the south of France are likely to see further rising in demand. Also, suburban areas will stay attractive, for instance, in Paris around the Grand Paris Express stations. In addition, high demand in areas outside regional capitals is set to continue in Italy, while Spanish regions with large supply-demand imbalances, such as Valencia, Catalonia, Madrid, Balearic Islands, Canary Islands, may even experience price corrections due to higher tourism exposure and uncertainty about rental regulations. In contrast, in Germany, the impact of the COVID-19 has been limited, and we have not seen any larger shift in household preferences. Overall, we expect the German residential market to stay robust amid sustained demand and lasting housing shortage.
I can confirm that investors have a strong interest in the German residential investment market. We see several large transactions above 100 million. The trend to build bigger platforms and to optimize asset management continues. Initial yields will stay low, and debt is not a problem. I would like to draw the attention to another risk apart from the unemployment rates. Although Germany has a well-balanced tenancy law, there are some political initiatives for a tighter rent regulation. We should observe how this might affect the asset class. But the trend is clear. Residential will stay a sought-after asset class, which has shown its resilience.